Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, traders and investors out there. Welcome to this Wednesday edition of Benzinga's PreMarket Prep, brought to you by Thinkorswim and TD Ameritrade. I'm Spencer Israel, here with Dennis Dick today as Joel continues his vacation or exodus or whatever you want to call it out down in sunny Florida. On today's show, we got a pair of guests for you. Tim Anderson, Managing Director at TJM Investments. He will be calling us live from the floor of the New York Stock Exchange. And then also we're talking with Cody Willard. You may remember him from his time on Fox Business. He's a former hedge fund manager and currently the proprietor of trading with Cody.com. We've got some earnings to discuss. Nike, FedEx, Finish Line, AVGO got pumped by Cramer last night. Dennis has some thoughts on that. And steel stocks, can't keep them down. That's what we're going to discuss on the show today. Dennis, how are you doing and how's your back?
Back's okay. I just saying to you earlier on the pre-market show, don't turn 40. Once you turn 40, you wake up in the morning and your back hurts and you got aches. I remember when I was a young buck like you, Spencer, I could take on the whole world.
Sure. I mean, I don't think I don't think you ever actually could. You just thought you could.
How's wrestling last night? You went to SmackDown. Tell me about that.
Yeah, I went to SmackDown. I gotta say, I was surprised at the sheer the amount of content and stuff they have, right? That's wrestling related. They have wrestling movies where the stars are stars in movies. They have a cartoon with there's a Scooby-Doo cartoon, like a cross promotional Scooby-Doo / wrestling cartoon where they solve mysteries, I suppose. They have video games. They have obviously I knew they had the network, so they have a ton of shows for the network. But I was just surprised at the amount of stuff they have. And there was there was more to the show besides the hour-long TV special. After they went off the air, there was more stuff happening in the arena. There's just a ton of stuff, and I was surprised that just how much they have, and they do it 3 days a week apparently. And oh my gosh, there's a lot.
So are you a wrestling fan now?
No, fan is a strong word. I would say
you respect it now.
I would go again. Absolutely, I would go again.
Are you going out and buying the WWE stock?
No, but they're in town in March, so maybe I'll go
back. Smack them down.
Maybe,
what's it cost for a ticket to that?
It's $30.
Oh, it's cheap entertainment.
Yeah. Cheap entertainment.
Who's the big wrestler now? Because we were talking obviously Legacy yesterday on the show, talking the Hogan days. No. Who's the big wrestler now there in the WWE?
A guy named AJ Styles, who I couldn't tell you anything about, except for the fact that everyone there has long hair. I noticed that. It's every wrestler has really long hair, and I asked why, and they said because you make the hair wet and the hair flies around and it adds to the effect. That's what I was.
Is the Undertaker still in there?
No, he wasn't there last night. I don't think he's been in.
I think he's still around. Is the Undertaker? Ask Shubs. Is the Undertaker still in WWE?
Is the Undertaker still around? Oh, he says yes. Okay.
Yeah, the Undertaker was awesome.
All right,
so it's 25 years that guy's been wrestling.
I'm not sure.
Timeless.
Yeah, I'm not sure why. I'm not sure why I had the Nielsen chart up for you, but there's the S&Ps. You can see it. Let me pull up a 5-day for us. S&Ps. Obviously, we continue. Well, yesterday was actually relatively. Wait, what's today? Today's 21st. Yesterday we closed higher as we always do. So let's get into some earnings, though. We did have...
Jump over here. There was quite a few earnings reports, actually, for being 4 days before Christmas. There's a few companies reporting. The big ones last night while you were going to SmackDown, Spencer, Nike reported earnings here, and the stock got a big lift, and then it pulled back, and now it's still up here, but it was a pretty good quarter.
Yeah, Q2 EPS 50 cents versus 43-cent estimate. Revenues $8.2 billion versus $8.09 billion. So looking good there. And we listened to the conference call there for, I guess, the entire thing. We had it up on the desk, and nothing too interesting came out of the call. They did say that management is expecting a return to growth in their basketball business over the back half of the fiscal year, so the next 2 quarters. And they did say that their Nike brands in North America inventory is down about 4%, but nothing too
Stock
notable.
lifting 2.5. Like I said, it was a little bit of a yo-yo last night. I had the big lift. I actually did short it on the spike, and I pulled in there nicely, and I had a nice little trade on after hours. I have no position on it here now. I'm looking at it. It's kind of stabilized here around $53. So let's see what this does pre-markets, or let's see what this does, in the regular session. It's had a pretty busy pre-market. It's already traded 127,000 shares, so it does look like it wants to go higher, and obviously it's a pretty good report here. So we know where support is. Support's probably kicking around. Well, support is probably going to be around yesterday's high now, which was 51.99. So if it pulls anywhere back towards the lower 52s, I do think you probably have some buyers coming in, maybe people who were leaning the other way, because even me, I was a little bit bearish coming in the report. I was concerned that it had hung out too long, and if they had announced anything disappointing, I thought it could breach the 50. They didn't. They announced a pretty good quarter here, so it looks like that is safe for now. But I think the old resistance around 52 will become support now.
All right, and let's move on to Finish Line. They
reported
this morning sympathy play in general, I would say, but they also happened to report this morning. The Q3 EPS for Finish Line, a 24-cent loss versus an 18-cent loss. Estimate revenues of $371 million versus $411 million. Not good there as far as the fiscal year 17 comp. Same-store sales, they're ranging from flat to up 1%. The EPS they project is $1.24 to $1.30. $1.53 was the estimate there. So
that sounds like a lot of misses.
Yes, let me pull up that chart for you, but a lot of misses there for Finish Line, which I only ever see in Macy's.
I've never been in a Finish Line. Is that where the Finish Line shoes?
Yes.
Do they have a store themselves though?
They have like a stand in a section, a kiosk in like Macy's is the only place I've ever seen them.
Okay, so moving all that aside, you're getting shellacking on the stocks, down 16% here this morning. So the entire November gain that it got for the Trump rally is now gone. Now you think about the low of the move. The low of the move was 1906 back on November the 1st. That's the level that it absolutely needs to hold. If I was short this stock, I'd probably be bringing it in right in here in this lower 19s because there is some support there. Starts to take out the lower 19s, then there's an opening actually all the way down. I'd say almost to the 16 area, because if you look back, just going back into June, you had a big run from 1679 all the way up into the 20s. So there's a lot of air below 19, but as long as 19 holds, you might get a few people doing some bottom fishing in that area. So I think that's the first level. Starts to breach 19, then you start to get very concerned. So cautiously, I find cautious support at 19.
I'm still surprised to see how good a year they've had. I mean, if you look at a yearly chart where they started January at, they were in the 15s, and we're at 20.
Yeah, it's not bad.
24 last week. So I mean, not a bad year for a stock. I don't follow this stock at all. Wouldn't have thought that, but not a good report and very very bad guidance. So we'll see what happens in the new year. And then let's hit on Under Armour just because it is a bit
moves with Nike.
It does move with Nike a little bit, so let me pull up a 5-day here so we can get a little
trading
bit
up in the pre-market. Under Armour has fabulous support down here around $25. And so it done the little rounding bottom thing after it had the big run up just a week and a half ago. 6 down days in a row is right in the area where it had found support before. November had major support around 25. People buying a little bit ahead of that support, 25, 26, 25.47 the low yesterday there. Now you're getting a lift here because Nike's trading up again. If you're trading Under Armour today, you want to keep Nike on your screen because Nike will be your leader. If for whatever reason Nike starts to roll over, Under Armour will roll over too. Or if Nike continues the run and starts to really run off the open, then you're going to see Under Armour lift as well. And remember, you have your choice. You can buy UA or you can buy UAA because Under Armour has the two stocks. UAA is on fabulous support as well at $30 there. So keep in mind, Under Armour, lots of support right there, right now.
Moving on to FedEx reported yesterday, Q2 adjusted EPS $2.80 versus $2.60 estimate. Sales of 14.9 versus 14.92 billion, so pretty much in line there. Did spike down immediately after the report. They did say fiscal year 17 EPS will be $11.85 to $12.35 is the range. The estimate was $12.16, so right in line there. and shares were down a little bit. I think right after it, you can see that
Yeah.
on the chart.
Inline just not good enough. They need to beat because when you see a stock run from 170 to 200, it's got to beat. Inline is not good enough. I thought they might beat, they did not coming in line, so that's why you've seen the stock a little bit under pressure here. Not down that much considering it had a pretty big run and just come in line. Only down 5 points is really not down that much. It's another stock that has, been on an incredible run, and I'm not sure people are just going to run out and start selling this thing under 190, 185 because it is loved. So this might be one of those. In a few days, the dust starts to settle. People might start coming back in here and buying this thing again. So pullbacks, it seems like on these real strong stocks, seem to continue to get bought here, even though this one's off earnings. I wouldn't be surprised if you find some buyers on the pullback.
And then is it taking UPS with it? Let's see. It is.
A little bit. Sympathy has not been going as much, though, as it has in the past. I've been saying this from the show for the last few months. A lot of the sympathy trades, they get a little bit of sympathy, but they're not pulling back as much as you'd think. UPS is down about $1 in the pre-market, so it is pulling back. UPS is already broken on the chart, though. Like, UPS broke on the chart 4 days ago, which I guess, is a little concerning if you're FedEx when you look at the UPS chart. It topped out at 120, had the big red candle down to 116.5, then it's popped up back to 117.5. Now it's going to challenge the low of the move, I'd imagine, down at 115.09. So that's the number I'd keep in mind if I'm trading UPS, that low from the 16th, which was 115.09.
All right. A few minutes before our first guest, what do you want to hit on in the meantime?
Let's go jump over to a couple of these other earnings reports here. Might as well just finish them up. Accenture, ACN is trading down 3 points in the pre-market there. Give me your thought, or give me the numbers for ACN.
ACN was Q1 EPS $1.58. Estimate was $1.49. Revenues of $9 billion versus $8.59. So looking good there. They see Q2 revenues of $8.15 to $8.4 billion versus an $8.5 billion estimate. So a little bit lower.
That's where they get, yeah.
A little bit lower there, and they also lowered their fiscal year 17 EPS guidance.
It's all about guidance. I mean, guidance always trumps the earnings. So when you are a little bit light on your guidance, they're usually going to hit your stock. And that is what you're seeing in this case, Accenture trading down. It was trading down. It's bounced back off the lows. It was trading at 119 just a few minutes ago there when we started the show. It's up at 121 here now. So there's people buying on the pullback. Again, this has been a strong one. So I think you have major support down there in the mid. 115 is huge. I mean, if it can get down to 115, it's all kinds of support down there. If I had another low at 116.17, a couple other lows, say you get into the 115, 116, 117 area, all kinds of support below. People may be stepping ahead of it at 119 here this morning, but it's bounced up. It's trading 121 right now. It looks like an iceberg at 121 though, so maybe it has a little bit of trouble going through. But I'm not running in to buy it when the guidance wasn't that great.
Yeah,
so
I thought Trump trumped earnings. You said
Trump.
You said,
what did you say?
You said guidance trumps earnings. I thought Trump trumped earnings. All right, never mind.
Trump trumps everything.
That was a bad joke. Okay, I will go back to
Trump. It goes Trump for everything.
Trump
center,
guidance, then
guidance,
earnings.
center.
Okay.
Trump trumps everything.
Gotcha.
If Trump comes out and says he likes Accenture in a tweet today, it's going higher. Trump trumps everything.
Okay. I don't think there were anything else that I saw earnings wise. I mean,
Winnebago. I want to see Winnebago. So we got 30 seconds here before we go to get Tim Anderson there. WGO has been one of the most incredible stocks of 2016. The forgotten child here started the year down around $16.
Yeah.
$37 yesterday. It's up another 2 points here today. Everybody, you see those Winnebagos everywhere now, don't you, Spencer?
No, but I remember I remember us talking about this back in like Q1, I want to say, or Q2, and you guys were shocked at where it was at. But anyway, Q1 EPS of 42 cents versus 31 cents. Revenues at 200.
I was shocked it wasn't coming back with such low oil prices. So weird. You'd think it'd be a direct, negative correlation with oil. And at the beginning of the year, 2016, oil was in the dumpster.
Yeah,
trading down at like $29.
Yeah.
And oil's come back here, and Winnebago's come back with it. So that completely mind boggles me. I would think, with $27 oil, everybody would be running to go buy their Winnebagos. But maybe there was a lag there. So I guess. I guess there was, so everybody's going to jump in there and buying their Winnebagos here now. But $39.45 worth trade this morning. What were the numbers?
Yeah, 42 versus 31 cents on the EPS. Revenues of 245 versus 232 million. So beat on the top, beat on the bottom. Winnebago just keeps on trucking.
But been such a run here now. I mean, this is the definition of chasing here. I think eventually this thing's due for a pullback. It's way overdone, in my opinion.
All right. We got our first guest coming right up now. It's Tim Anderson from the floor of the New York Stock Exchange. So We'll be right back with Tim.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.
Welcome back, traders and investors, to Benzinga's Pre-Market Prep. I'm Spencer Israel here with Dennis Dick, and we have Tim Anderson on the line. He is the managing director at TJM Investments. He's calling us live from the floor of the New York Stock Exchange. Tim, how are you doing today? And is it as cold in New York as it is in Detroit?
I don't think so. I mean, it was very cold a few days ago. It's warmed up a little bit. I think it might be 40 degrees here.
Oh, wow.
Today.
40 degrees. What's that like?
I know it's pretty cold out there because my folks are in Grand Rapids.
Yes, it's been a frigid week. Okay, Tim, the first question I have for you is this Dow at 20,000. Why should I care? I guess I just don't see it. To me, it just seems like such an arbitrary number, and I don't really care. So tell me why I should care, or tell me why I shouldn't care.
I'm not going to disagree with you that it's an arbitrary number. And I'm the type of a guy that typically would say, okay, who really cares? It's just a number. You know, people make a big deal. Years ago, we went through 12,000, 13,000, 14,000. I might have those metrics wrong, but we went through 3 millennial markers all in 1 year or in a short period of time. Clearly, but I think that 20,000 was a little bit different. I think it's very significant. It means absolutely nothing in terms of valuation metrics, but I think for market psychology, it means a lot. And psychology happens to be very important for the market right now. Now, you could easily take the other side of that and say, look at the S&P 500. The S&P 500 went through 2,000 like nothing. No, not a lot of resistance, and not a tremendous amount of backing and filling before it went through. But it struggled for about 18 months with the 2,100 level. Maybe 2,100 is a Fibonacci number. Maybe it's a count number on some other cycle work or something like that. I am far but an expert on any of that stuff. I just think that the 20,000 hitting it now is what would have been a very unanticipated event a few months ago or in the middle of the year. And if we go through it and sustain it, it will end up being very significant.
I agree with you here, Tim, and I am not a Dow fan.
On the psychology, purely psychology. Market's very psychological. You know that, Dennis.
Yeah, and I agree with you here. And I'll tell you, from my personal standpoint, I don't even have the Dow on my screen. I have a million tickers on my screen, and I don't even have the Dow on. I only look at the S&P. But most professional money managers or most prop traders or professional traders look at the S&P more often. But the general public does not follow the S&P at all. The general public follows the Dow. And if you're thinking, where most of your money comes from is the general public. It comes from, and then goes to the money managers. That means that psychology aspect of getting over 20,000 is important. So I agree with you because the money at the bottom line comes from the general public, and that 20,000 number matters to the general public.
Right. I agree with you, and I think that, look, I've been doing this a long time. Okay, I'm old. All right, I don't have a better way to put it. So, when I started in the business, everybody followed the Dow. I mean, I'm not saying the S&P wasn't there; it definitely was there. And then, of course, when they started trading S&P futures and a lot more derivative products around indexes, all that started was much more prevalent with the S&P than it was against the Dow. It was actually restricted to trade any of that stuff against the Dow for a long time. I can't remember exactly how long. But the other thing about the Dow is that a lot of companies in it, and I don't know that I don't really believe it's necessarily a requirement, but there's probably a higher yield component to the Dow than there is some other indices. The one interesting thing about the recent strength in the Dow is that a lot of those stocks are very dollar sensitive. When the dollar broke out from its low, maybe a year and a half ago, the Dow got hit in that one big sharp October sell-off we had, and that was largely attributed to the strength in the dollar. Well, look at the strength in the dollar now.
Is it time for, I don't know, the Dow's never going to do this, but it's such a, index with only 30 companies, but the biggest problem is that it's price weighted. And you see a company like Goldman Sachs in the Dow. And I just saw a stat across my timeline, I think it came from Zero Hedge actually, that said, of the gains since Trump, 21% of the Dow gain is Goldman Sachs. 21%. So literally over a fifth of it.
Well, the
is
stock,
just from one
stock is up like 35%.
And it's a $200 stock. So
look at IBM.
Weighted heavier.
I mean, IBM is right. I mean, did Apple, when Apple split, did they do that with the idea that maybe it would make it more attractive for some of the indexes down the road? Look,
what do
you never say never. At one point in time, they never would have had NASDAQ stocks in the Dow until they included Microsoft and Intel.
Yes.
So, the one other interesting comment that I think you have to make is there's always been almost a little bit of a contrary indicator to them taking stocks out of the Dow, because they take stocks out when they become low single-digit stocks that have been beaten relentlessly, financial problems, and it seems like maybe they're going to recover. They took Alcoa out, what, a year and a half ago?
Yeah.
Somewhere between a year and a half and 2 years ago.
We're at the bottom.
The stock has doubled. Dennis, they took Chrysler out when it traded at $3.50 in the early to mid 80s. This stock went up tenfold.
After that, the minivan.
Yeah. So
let's move away from the Dow here, Tim, and because we're only got a minute left with you here, and let's talk the rotation, because the rotation keeps happening here. I look at my screen, and every single day, I never see a day that I come in and every sector is red of equities. It's always like, okay, well, you're going to see the money rotating out of financials, but it's got to rotate into some of the defensive plays then. But it never seems to be rotating right out. And, and until you see that, that day where you start seeing, the rotation right out of equities altogether, I think we just keep clawing our way higher here. So what do you see here for the year end?
I just think that the big monster institutional money managers seem to want to have as close to zero cash at the end of the year as possible. And they also have a investment landscape for the next 4 years that was unanticipated before the election. If you look at look at the Trump economic plan, and it's a plan. The devil will be in the details. There's no doubt about it. But it's kind of like one of these three-legged stool type plans. You've got tax reform, most significantly lowering the corporate tax rate to 15 or 20%. And that includes then also repatriating $3 trillion from overseas back over here at 10%. You've got a massive infrastructure spending program. Again, the devil will be in the details. And you have a much less onerous regulatory climate going forward from a multiple of angles. Okay. Now, financials obviously helped by higher rates, a steeper curve, and a less regulatory environment. They've kind of been the personal ATM of the government for the last 8 years. Infrastructure spending, those stocks have been on fire. And now I think the other sector to really look at here is oil. Because if you can get some people, some analysts to do some work that are smart enough to tell you what stocks are really going to thrive in domestic oil production with an environment of oil in the low to mid 50s, those stocks are going to do very, very well the next 4 years minimally, maybe the next 8 years. Look how strong the dollar is. Oil holds above 50. Okay, the Saudis obviously have made a shift. They're no longer going to be totally driven by market share like they have been for the last 2 years. They're a little bit more price sensitive. But in the 50s, a lot of these frackers or shale companies that cut back the ones that can be profitable, they're going to be online, and it's much easier for these companies to go back online after being offline than they used to years and years and years ago. So you got to think like the service companies that probably should be front and center.
All right. Tim Anderson, he is the managing director at TJM Investments. Tim, thank you so much for coming on. We will talk to you again in the new year. Have a good one.
Have a great holiday, guys.
All right.
Thanks, Tim.
Always good analysis from Tim. And a great point on the Dow. I guess market is psychological. I get that. It just seems to me I'm just tired of hearing about it is my point.
I'm done with the Dow. I was done with the Dow when I started in 1999 when I came from retail into prop because everybody, in my office, always following the S&P. We're looking at the S&P futures. So, but the general public likes to hear the big number.
Yep.
Like, I'll just say this. When I have friends that aren't in the industry, they never ask me, "Oh, what did the S&P do today?"
Right.
They always ask, "What did the Dow do today?"
Yeah.
And that's very typical. The general public follows the Dow; they don't follow the S&P. So I think it is a big psychological hurdle. And I do think when you get this Dow 20,000, maybe it interests the general public again, and maybe more money starts to move into the markets again.
And then
I think it does matter. Even if the Dow ever mattered, it matters now.
And then you say, "I don't know what the Dow."
At least for this moment in time.
You say, "I don't know what the Dow did," and they say, "Well, what do you do all day?"
Oh yeah, I know. That's exactly it. I say I have no idea what the Dow is. Is it at 19? I don't even know where it is at 19. Now I know it's near 20,000 because everybody's talking about it all the time. But before that, I have no idea what the Dow did. I tell you what the S&P did.
And they say, "Gosh, Dennis, you must not be very good at your job if you don't even know what
the
Dow
did." No,
did."
you don't know what the Dow did. Who is this guy?
Okay, all right. Enough of that. You have thoughts on Broadcom, AVGO. You said on the pre-market show that.
Yeah, we look at charts every once in a while, and I watch Mad Money. You got to watch Mad Money if you're trading, after hours there, because Cramer moves stocks. You got to respect him. You don't agree with his opinion all the time. He's a mover. He mentions the company, it'll move. He was pumping AVGO last night. It's up $1 this morning. So you're wondering why AVGO is up? You can thank Jim Cramer for it. It's trading up $1 here in the pre-market at 183. And I agree with him on this one. I actually like this one. So, a lot of times, Cramer and I don't have the same opinion here. Here we do. And maybe that's a dangerous thing. But just looking at it, this looks like a classic breakout here. The stock has had major resistance at 180 for a long time. It broke out on the candle yesterday to make a new high. Continuing here this morning as well, obviously, because the Cramer pump there. So it starts getting above yesterday's high, 183.28. Could be off to the races again. I know we have a little bit of weakness in the S&P. Get a little pullback maybe in the open at AVGO. But this is one that interests me here, especially, seeing how, some of these other tech stocks have really ran here. I think AVGO could be a run too, and I think you might see this one start to run in through the 180s, and maybe this thing can try 200, try to get to the 200 area, within, by year end, but it's 18 points higher. But I like this one.
What exactly was Cramer saying about Broadcom?
I don't follow the argument.
Okay.
So
Okay.
here's
Okay.
how I watch Cramer. What stock is he talking about? Now I'm trading it.
Okay. Okay.
So
Okay.
I don't totally listen to the argument all the time on exactly why he likes it or why he doesn't, but I need to know if he likes it or if he doesn't.
Okay.
Because when he says I like it, the stock is going to go higher. When he says I don't like it, the stock is going to go lower. It's like an earnings report almost, like you come in here and you say, and when he focuses, like Mad Money will focus on 2 or 3 companies every show. The companies that he focuses on move. Now, if he just mentions it in his, a lightning round or whatever, probably not going to move because he's just mentioning it in passing. But when he focuses on a company, it moves. So you have to respect Jim Cramer. And even when, he's got his, talk there at 9 o'clock after, our show gets done at 9 o'clock, I always go flip on Jim Cramer because he's talking with David Faber in the morning. And he can move stocks just by mentioning him as well. So you have to respect the guy. I mean, he moves stocks.
All right. 8:31. Let's get a quick and balanced look.
Haven't even looked at them here today. So hot off the press here, 8:31 minute. Twitter, 68,000 to sell. We have not talked about Twitter yet. It seems like every exec is running for the hills here. You were talking about this. We lost 2 more yesterday. Who did we lose, Spencer?
Oh, we lost the CTO and someone else. I'm not remembering. Let me get it pull up for you in the Pro. But the CTO is gone. Adam Messenger and the VP of product as well, Josh McFarland. So I saw a graphic there. I think it was like the Twitter leadership team. It was like the eight people on the team to start the year, and like 6 of them are gone.
Yeah. And do you think this is a little bit internal too? Like, do you think they're pushing these people out because obviously the company can't seem to get it right, or do you think people are bailing because they're worried that the ship is sinking and they don't want to be on the sinking ship?
I don't know. What's interesting is it seems like we've seen at least 2 or 3 different excuses for leaving. Yesterday Adam Messenger was he's taking some time off, right? So that was his reasoning. We've heard in the past.
Doesn't sound like a good excuse.
Hey, I'm
taking time off.
I'm not the arbiter of a good excuse or not. But so we had that. We have had people leaving for other companies. We've had, I'm taking like a more passive role in the company. So we've heard a few different things with regards to why people are leaving Twitter, or at least leaving their current roles in Twitter.
It's concerning here to me. This $18 level is the big level. We're through it a little bit, and we cut through it there just looking back just a couple of weeks ago. 1773 was the low back on the first. So that's why first bogey here needs to hold 1773. I mean, anybody who is sitting around here waiting for an offer and, is in it for that reason is starting to get a little bit nervous here as we're starting to breach down now through that 1773 area there. Get through there, you start thinking the 17 number here again. I've talked about being long Twitter. I do think eventually they're going to turn it around. I am not long Twitter here right now. I sold my stock, obviously, when it had the big spike up on the rumors that it was going to get taken over, and I thought it got a little bit overdone. Glad I did that. I've been wanting to rebuy it, and I've talked about rebuying it at the 18 level. For some reason, I'm holding off here, though, and I'm starting to get concerned too many execs leaving and stuff like that. So I'm going to hold off on my purchase of Twitter here just yet. I might regret that decision because I said I would buy it if it got back to the 18 level, and it did yesterday, but I'm still not pulling the trigger.
I'm still afraid of Twitter in general.
Valuation is still a little bit, until they get it right. It's not growing anymore. That's one big problem. Second problem is, they've got to figure out how to monetize their user base better. If they can figure that out, maybe they can go with just the user base that they got, but it's not growing anymore. And there's a lot of alternative platforms as well. So I like Twitter. I think as a stock trader, it's a great tool in your toolbox. I think, the general public still doesn't get it, though.
I think Snapchat IPO, I think, would be bad news for Twitter.
So you're concerned about competition as well.
They're relatively similar platforms. I think there's only so much money to go around in social media land. Is how I feel. All right.
And what's to say something else new doesn't pop up that's cool too? It's gonna. There'll be something else like, oh, did you see this thing? And everybody pops over on that too.
But Snapchat is an example because they've been around now for probably a little over 5 years at this point. That's an example of how a company evolves. Because if you and I use that, and if you take a look at the amount of features that they've added just in the last 2 years, it's staggering. the new things they've added to the platform, and that Twitter is not adding to their platform. So, food for thought. All right, 8:35. We're going to take our second and final break of the day. We're going to grab Cody Willard. He used to be on Fox Business. He used to run a hedge fund. Now he runs tradingwithcody.com. So we'll be right back with Cody.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.
Welcome back, traders and investors. This has been Zinger's PreMarket Prep. I am Spencer Israel here with Dennis Dick, filling in for Joel Kahn today. And we are on the line with Cody Willard, tradingwithcody.com. Cody, how you doing this morning?
I'm doing great. Thanks for having me, guys.
Thanks for coming on the show. So tell us a little bit about your background. I know you ran a hedge fund. I know you're on Fox Business, but how exactly did you get and now you're on trading with Cody. So tell us a little bit about how you got started in the game.
Well, frankly, I'm a cowboy from New Mexico, as I like to say, at least by New York standards. I don't know if a lot of people in New Mexico would consider me a cowboy, but I bought a one-way ticket to New York in 1996 and started off as a barista at Starbucks and just kept hounding Wall Street firms until I finally got a few job offers as a stockbroker even. Eventually, I left there. Just within a year, I left there and ended up at a venture capitalist firm, and then eventually I wanted to start my own hedge fund, and Cramer, I was writing for TheStreet.com, and Cramer knew I wanted to launch my hedge fund, and he was kind enough to sit down with me actually and give me a lot of introductions, and along with Doug Cass, helped me launch my hedge fund in 2002, which I ran to 2007, when I then went to Fox Business, and these days, as you noted, I am running tradingwithcody.com, where I post all of my personal trades and positions.
Talk a little bit about, your trading style there. Are you longer term? Like, what's your time frame on some of these trades, and how often are you posting? Ideas?
I do what I call revolution investing for the most part, and so I am pretty much a long-term investor. My biggest positions are Apple, which I've owned since March 2003 with a $1 cost basis on my first shares.
Wow.
I've owned Google since the day it came public with about a $45 cost basis. And I bought Facebook as my most recently biggest home run. Well, actually, NVIDIA this year also I hit as a big home run. So, I've got NVIDIA, Amazon, Facebook, Google, and Apple as my 5 largest positions, all of which I've owned. Apple I've owned for 12 years, NVIDIA I've owned for about 13 or 14 months.
Where are you coming up with those ideas? Because those are fabulous companies that you've bought for the long term. You picked all the best ones. How are you coming up with those ideas?
Better to be lucky than good in some ways. But no, it's all out there in the internet, and anybody who's been following me for all these years knows that what I try to do, it's obviously I spend, 70, 80 hours a week studying markets and technology and just sort of the economy even. But I do try to find what I call, not just disruptive companies, but companies that are truly revolutionizing the world. And that is clear that Apple, Google, Facebook, Amazon, those companies have revolutionized the world. And I think artificial intelligence and self-driving cars and so much of the stuff that NVIDIA has positioned itself for right now in the next, say, 5 years is probably the next big hit on that. And I think NVIDIA probably has another triple from here, although I've already got about a 250% gain in it over the last 14 months.
So you'd still be a buyer here at NVIDIA, even though this thing has run up 30 points in the last month? Or would you wait for a pullback?
I'd wait for a pullback. I mean, I'm actually probably going to trim a little bit of my own, maybe 10% of my position after getting a triple on it here. So, I that's part of what I do too. I'll trim a little bit, 10 or 20% on occasion when I get a huge home run that's or a stock that's just rallied 30% in 2 weeks or something like this.
Yeah.
And then when it comes down 30%, if I believe in the fundamentals, I've done this with Apple, Google, and Amazon for 10 years, where every time it gets crushed 20 or 30%, I buy a little more.
Okay, big $1 million question here is, what do you like going forward here now? You liked Apple back in 2003 and Google back at the beginning and NVIDIA here. What do you like for 2017? Are you out there, looking at any companies that are going to change the world here?
Sure. So, it's always what have you done for me lately, right? But this week, I'm actually coming out on tradingwithcody.com, as you guys mentioned, where I do a trade alert that every time I buy or sell a position, even just trimming or adding a little bit to a position. I'm adding a new position this week. It's a derivative play off of the cloud and apps and the app revolution. I'm not going to give it away just yet because I haven't published it for my subscribers. Another one that I am buying right now, though, or recently bought, is Impinj with the symbol PI. It's an RFID platform, and I think it's, again, like you saw recently, Amazon rolling out their grocery store where people can just pick up items and walk out. That is going to be enabled by RFID, and probably we think that Impinj is the actual company that is doing that for Amazon. We don't have proof of that yet, but I think RFID, passive RFID, and in the grocery stores and in the factories and in the warehouses is probably going to be a big thing over the next 5 or 10 years. And if this company or any other can figure out how to become that de facto standard across the industry, they'll be worth, tens of billions of dollars. And so that would be another 5 or 10 bagger if that were to happen. Of course, guys, I have losers too. I mean, it's not like it's all gravy and parties over here. I, for example, lost money on Fitbit last year. That was one that I thought would got cheap enough I could probably ride back up. It's not really a revolutionary company, and it happens. So just to be clear, I don't want to just make it sound like everything I bought goes straight up.
What do you do in a stock like Fitbit? Do you look at this and say eventually cut your losses that your initial analysis was wrong, or do you hold on until they eventually start to give you some type of pop to get out of? How do you handle the losers?
Every time it's different, but the key, of course, is developing the discipline of taking those losses and moving on from losers. And obviously, as in my case, specifically, as you've heard, holding on to my winners. And I've done a very good job of holding on to the winners. I really was disappointed in myself in the way I handled Fitbit last year, as I wrote it down from 20 to 14, and I just didn't. I started losing faith. I thought Fitbit was going to be a much bigger platform, and I thought they would have, even chips that you would have embedded in your skin that were measuring your oxygen and output levels and calorie burns and things. And I thought they were really going to become a huge, much more scientifically advanced company. And instead, they've recently bought their smallest competitor, Pebble. And so the answer to your story is I sold the stock at $9 after it got crushed not the very first day at the most recent earnings when it was down 25 or 30%, but I waited probably a week until it sort of settled down, and I sold it around $9. I mean, it was a terrible loss. It happens.
Do you now let's just talk, from an investing standpoint. Do you use a lot of traditional diversification in your portfolio? Do you look at different sectors? Do you have a bond equivalent, or are you mainly just trading and holding equities?
I am. I do very little. I don't like bonds specifically, just sort of as a demographic kind of play here. I think we're probably near, whether it's this year or in 5 years, the end of a giant bond bull market. And so, no, I don't have a lot of bonds, and no, I don't believe in diversification across my stock portfolio per se. I believe in finding the most revolutionary companies and exploiting the edge that I have of understanding technology and platforms and the internet and apps and trying to be ahead of the curve in those. And having done that, I think it's worked well. But I don't, for the average veterinarian like my father, who's 60-something, now 70 years old, and yeah, he needs to be a little more diversified than, say, someone like me who does this for a living. But personally, yeah, my stock portfolio is probably 80% technology. And then I have real estate here in New Mexico. I own some acreage and a ranch house and things like that. But I don't diversify my portfolio in the same way that most people do.
Cody, one stock here before we let you go. Just want to ask you, because you're talking revolutionary companies, a lot of people think Tesla is a revolutionary company here. What are your thoughts on Tesla, and is this one that you're attracted to, or is just valuation an issue?
I've long derided Tesla, and I'm not a big fan of Elon Musk and his welfare-begging policies coming to New Mexico and trying to get us to give him $1 billion of welfare to build his gigafactory. I was so glad that we didn't do that, and that he eventually went to Nevada to get welfare for his company. And then, of course, on the federal level, you get an $8,000 welfare check if you're rich enough to buy a $120,000 or an $80,000 electric Tesla car. I think both of those things are just egregious and gross. I think that welfare should be for the poor, not for the rich, not for corporations. That being said, I was recently in San Francisco at Mill Valley with my friend Bob Weir at dinner one night, and he wanted to go out to his car to get his chew or something. And we went out, and he had a Tesla, and he had boop, boop, and it was the brand new one, and popped open the door. And I said, "What do you think about your Tesla, Bob? Are you liking it?" He said, "Man, I love it, but what I really love is the fact I put a Solar City panel on top of my garage, and I drive completely free and have zero emissions from all of my travel in this car, and that's the coolest thing ever." And I thought, that is pretty cool, Bob. But at the same time, he also was the one, of course, you get so much welfare for putting the Solar City panel on top for the Tesla car, et cetera, et cetera. That was a long story to say, no, I don't like Tesla. I don't invest in it. I don't like a company that is that heavily dependent upon welfare. Don't get me wrong. Google and Apple and Microsoft don't pay their fair share of taxes either. If small businesses are paying 30%, every company should be paying 30%. But regardless of that, welfare for Tesla is just so egregious. It scares me.
Do you go short as well, Cody, or just long?
I absolutely do.
Ooh, what companies do you like? What companies don't you like?
Okay, I'm short Herbalife, for example. I shorted that one after they declared victory against Ackman. And I think basically they lost. The federal government has come in and said, you guys, your entire business model is, if not fraudulent, misleading, and you have to change all of it. And everyone's like, whoa, they won. Herbalife is in the clear. They settled with the government. No, they're going to be in big trouble, I think. I think their entire business model is about to collapse underneath them. I know that Icahn is a huge investor in it. He's been on the other side of it throughout this. I hate betting against Icahn, but I think he'll be wrong on Herbalife. I think it's probably even a zero at some point, if not at least a small fraction of where it is right now. Another one I'm short is HubSpot, HUBS. It's a digital marketing thing, and they're not profitable, and I don't know if they'll ever actually get to the profits that they're looking for. Great growth rate there, and I've battled that one from I think I shorted around 53. I rode it up to 60 and shorted a little bit more around 58, and now it's around 47, 48. And I do think it's heading lower, but that one's been a tough one on me for the last 6 months.
I could not agree with you more on the Herbalife thing. Don't know a lot about HubSpot, but Herbalife, I'm right with you there, Cody. Cody Willard. He runs tradingwithcody.com. Thank you so much for joining us today, and we will have you back next year. Have a good one.
Hey, thanks, guys. Good show. Talk to you soon.
All right.
Thanks, Cody.
That was great. Dennis.
I'm glad you asked about the shorting the stocks because it gives a whole different perspective. When he's looking long term like that, he's looking for long term companies that are bad too.
Yeah, so, that was wonderful.
Nice
you know what? And I like how his ultimate Tesla conclusion is kind of like mine. It was like, oh man, like they do good work, right? Their product is good, They do good things, but it's how they get there that's problematic. And I agree with that too, honestly.
Even the Solar City Tesla merger, we talked about that for a while, and really, Tesla was a bailout of his Solar City company.
Right.
So I don't like the way he did that either. So I don't like the way he's out there and he's tweeting, "Oh, we're going to come up with something." He always seems to be wanting to move his stock price too. I'm not the biggest Musk fan. I respect him because he's come up with some fabulous ideas but I don't know if I'm the biggest Musk fan either.
All right, let's hit on ratings land. We haven't touched on any ratings today. What sticks out to you the most?
There's a couple here. It's pretty quiet day for analyst ratings here. I saw Sunoco SUN catching an upgrade from Credit Suisse. That stock is trading up pretty substantially in the pre-market. It's interesting because Sunoco got murdered yesterday. So obviously Credit Suisse is coming out and defending the stock here today. If you look at the chart from Sunoco, went down from 24 to 21.90 yesterday before getting a pop. And here's an oil stock that has not come back. I mean, you can talk a lot of different oil stocks and you can look, but this one here was $50 at the beginning of 20 or middle of 2015. 2016 was $40. Now it's 22. It's kind of went the opposite direction of oil here. So Sunoco's had a rough ride. Obviously some specific company issues, but Credit Suisse coming out and defending the stock here this morning.
And then I also see Aegis. We had initiating coverage on Alphabet with a buy and a $980 price target. So let me look at.
I mean, just talking, and I still call it Google. I hate that they changed their name to Alphabet. I hate that they did the split in the two different company shares. But that being said, Google is still one of the core investments in my portfolio as well. I'm not in nearly as early as Cody. I was in from. I did the reverse split. I got to figure that out. So I bought at 500, but then it split and gave me two companies. So 250. So he was in for $45. I'm in from about 250. So, what I'm sticking with it. Google, I still think is going to eventually be the most valuable company in the world. I like you, and it's touched that already a couple times, not even that far off. And again, but we were saying that well before it was up there. So Fari and I were both on the agreement that Google. Now he's saying Amazon could potentially jump up there too. But Google. I like everything going forward. I think they're very innovative. They're always coming up with different ideas. And it's not a crazy multiple. You're not paying some crazy valuation for the stock. I think it's like 19, 21 times. So, it's really just a market multiple on a stock that still, they find a way.
What else you got on your radar? There's a few more that I saw, but I'm curious.
Biogen announced that spinoff, so BIIB. It was, obviously this was already, public information. They knew they were going to do it, but they officially announced the spinoff there after the bell. Do you have the details on that?
No, I don't. I'm not for you.
Let me go grab.
Let me grab. See if.
Well, it's a race.
It's
a race. You can get the details faster here. So, anyways, it was. I think you're going to get. And I'm a Biogen shareholder, so I'm always interested in this stuff. Biogen announces that
separation of their BioVerative unit declare a special dividend related to the separation. Every 2 shares of Biogen stock, Biogen shareholders will receive 1 BioVerative share.
So I'm going to get a new company. I'm sticking with Biogen. Like I said, I've had it since about $50. So, I'm sticking with it in my long-term investment portfolio here. Shorter-term trading perspective, sometimes this stuff can give a stock a lift. It was lifting a little bit last night, but lots of overhead resistance here. I mean, 290's been huge for this thing. So I think, it's kind of more of it was buy on rumor, sell on news type of deal, maybe. So I wouldn't be surprised if the stock actually goes down today.
What about a great point here? Was it Ace? Someone who brought up great Fred yesterday. What'd you make of that guy? Fred agreeing to acquire 875 Rite Aid stores for $950 million in cash. The stock was halted at around the time the news came out there. Let's pull up this chart.
Unreal. Stock goes from $11 and change to opens at 16 and then runs all the way to 21.77. So that's just a moonshot there. If I was in it, I'd be ringing the register.
Yeah. Wasn't Rite Aid They're involved in a merger.
Well, yeah, Rite Aid.
Yeah.
Here's the saga here. Obviously, they got the merger with Walgreens, right?
Right. Yeah.
And they've been saying, that they're going to block this unless Rite Aid gets rid of some stores. Well, Rite Aid need to do it. So Rite Aid need to divest themselves of some stores, and it looks like they're going to do it. So, this was good for Rite Aid here as well. You can see the RAD gap up here as well, because people are speculating that, hey, this deal might get done now. Back in November, when Trump got elected, we were thinking, oh, he's blocking all the deals, probably going to block this one too. Stock was way down at 650, but slow and steady, it's been climbing back up. And it looks like this deal is going to get done. I believe takeout price $9. So Risk Arbs here, are looking at it now saying, well, this deal looks like it's going to get done here at $9, $8.60. So it's already priced in that it probably is going to get done. So great, purchasing. I know a couple people in our chat were long this thing too. So we were buying it back in the $6.50, $7, $7.50 area. Congratulations here, because it looks like you're going to be right. And it looks like they're going to get this deal done.
Somebody asked also in the chat, who was it? Dr. J, comments on Square. There was a Nomura note yesterday. They initiated coverage on Square to buy with an $18 price target. They see 40% year-to-date gross payment volume growth. Great number there. Let me pull up Square.
It's been running. Square has been hot, and we saw multiple upgrades here over the last few weeks as analysts do chase price. Since beginning of November is $11, got up to almost $15 yesterday, $14.82. The one concern for me here is you're running into some old highs here very soon. Get back into March and April of earlier this year, you had all kinds of highs in the 15 area, 15.5, 15.87. So I think there's another buck or so maybe in there potentially. But, you're really reaching. That last dollar is always the hardest one to get. So if I was along this thing, I think I'd be ringing the register too, because there's a lot of overhead supply above 15.
Yep, completely agree. And we've observed how Square can also move in sympathy with Twitter in the past. So there's
not happening lately.
No, not right now. I'm not saying this morning. I'm just saying.
Twitter is a different story here. With the execs, it's now 17.63 since we just did a little piece. 10 minutes ago, just fell another 15 cents, which is almost 1% when you talk a $17 stock. So Twitter's under pressure. A lot of execs leaving. There's some people bailing out of this thing right now. So I'm concerned here below the 17.73 that I was talking about. I think Twitter could see $17. So I'm concerned here from the long side.
All right, 8:57 now. Any final thoughts before I let you go back to trade?
This is a tricky day. I mean, it's kind of quiet. We haven't really moved at all in the S&P the entire show. I think we've had a 1-point range since we started the show. But, I do see some stocks, taking leadership here. I do see the financials actually a little bit weak. So, if I'm looking, what's strong, what's weak on my screen right now, I'm seeing some weakness in the financials. I think some of your defensive names might be stronger. I saw some tobacco names trading up last night. If you look at the TLT, it's kind of just hanging out here, but it is up slightly here, and it was down earlier here. So you're starting to see a little bit of separation. It looks like it might be a little bit of a risk off morning, which means, the industrial, some of the, the cyclicals, they might sell those. They might be selling the financials. They might be buying some of the defensive names. Think, defensive, even pharmaceutical stocks. Those play a little more defensive role. I am seeing Bristol Myers, Merck, and Johnson & Johnson all trading higher here this morning. So I'm looking at those sectors as maybe potential buys just for the open. These are short-term trades. And then, financials are weak here. So any financials that are opening stronger, I might be looking to sell those for an opening trade.
All right, looking forward to tomorrow's show. We have two guests for you. One is Trip Miller, managing partner at Goulian Capital. They're a hedge fund. They hold about 20 companies in various long and short positions, including Netflix, Amazon, Apple, Disney, Penske, Royal Caribbean, and others. So I'm sure it'll be fun to talk with Trip. Also, we are talking with Pavel Molchanov, an analyst at Raymond James. So he's someone that we speak to frequently on the desk. Looking forward to having both those guests on tomorrow. Trip Miller and Pavel Molchanov. If you missed any part of today's show, including our interviews with Tim or Cody, Tim Anderson and Cody Willard, catch the whole thing again on YouTube. The show is usually available around 10 minutes after we get off the air here, and then in an hour or so on iTunes, SoundCloud, and Stitcher. If you just search for Benzinga or PreMarket, or go to any of our channels there. Don't forget to check out Benzinga Pro. It's Benzinga's real-time news platform. You can get it for free for 2 weeks by going to pro.benzinga.com. You can also call us up for your very own demo and discount. Just say if you listen to the show, 313-723-2000 is the number. I will give you a demo myself if you want that. I would do it just for you because I love you. So pro.benzinga.com. thinkorswim.com or 313-723-2000 for that free Benzinga Pro 2-week trial. Please remember that all the information, material, and content from our show is for informational purposes only and not meant to be investing advice. Dennis, I hope your back feels better. We will talk to you folks tomorrow. It'll be Dennis and I powering through the week with Trip Miller and Pavel Macharnov. Have a good day, everybody.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.